Good morning, Prof. Reyes and classmates. I'm Jasper Tago, and I'll be reporting the second part of Chapter 13 entitled Capital Structure and the Cost of Capital. The other half of the target capital structure in business is the cost of equity. Cost of equity is the rate of return a company pays out to equity investors or stockholders. A firm uses cost of equity to assess the relative attractiveness of investments, including both internal projects and external acquisition opportunities. Investor-owned businesses or for-profit businesses raise equity capital by selling new common stock and by retaining earnings for use by the company, like buying new assets, rather than paying them out as dividends to shareholders. On the other hand, not-for-profit businesses raise equity capital through contributions and grants, as well as by generating an excess of revenues over expenses or savings. Take note that none of which can be paid out as dividends. I will briefly discuss in the succeeding slides how to estimate the cost of equity capital of both investor-owned and not-for-profit businesses. Cost of equity to investor-owned businesses. We learned in Carl's report that cost of debt is based on the return or interest rate that the investors require on debt securities. The cost of equity to investor-owned businesses can be defined similarly. It is the rate of return that investors require on a firm's common stocks. Although the investor-owned firm's net income belong to the stockholders, as I mentioned a while ago, the management can either pay out the earnings or the net income in the form of dividends or retain the earnings for reinvestment in the business. If the firm chooses to retain a part of the earnings rather than giving it all as dividends, an opportunity cost is incurred. Why? Because stockholders could have received these earnings as dividends and invest this money in stocks, bonds, real estate, and future commodities. Therefore, when the firm decides on doing this, the business should earn on these retained earnings at least as much as its stakeholders could earn on the said alternative investments of similar risks. If the firm cannot earn as much as stakeholders can earn on similar risk investments, then the firm's net income should be paid out as dividends rather than retained for a reinvestment within the business. Now the question is, what rate of return can stockholders expect to earn on other investments of equivalent risk? The answer: by knowing the required rate of return on equity. Investors can earn this return either by buying more share of the firms in question or buying the stock of similar firms. Large investor-owned businesses use three primary methods in the estimation process. One is the capital asset pricing model. The second is the discounted cash flow, or DCF, and the third one is the debt cost plus risk premium model. There are no single approach that dominates the estimation process. The book stated that all approaches should be used to estimate the cost of equity, and then the final value should be chosen on the basis of management's confidence in the estimates at hand. However, when you look at other references online that is related to this, they claim that CAPM, or capital asset pricing model, is more widely used nowadays. In the interest of time, I will only be discussing capital asset pricing model in this presentation. The capital asset pricing model is a widely accepted financial model that specifies the equilibrium risk versus return relationship on common stocks. It describes the relationship between the expected return and risk of investing in a security. Basically, the model assumes that investors consider only one factor when setting required rates of return, and that is the volatility of returns on the stock compared with the volatility of returns on a well-diversified stock profit in the market. The actual equation that relates risk to return is the security market line. Managers can estimate the required rate of return on the firm's equity by using this formula, where the rate of return is equal to the given estimates of the risk-free rate plus the difference of the required rate of return on the market and risk-free rate multiplied by beta of the stock. This estimate, in turn, can be used as an estimate of the firm's cost of equity. Investors expect to be compensated for risk and the time value of money. The risk-free rate in the CAPM formula accounts for the time value of money. The other components of CAPM formula accounts for the investor taking on additional risk. The beta of a potential investment is a measure of how much risk the investment will add to a portfolio that looks like the market. If a stock is riskier than the market, it will have a beta greater than 1. If a stock has a beta of less than 1, the formula assumes it will reduce the risk of portfolio. A stock's beta is then multiplied by the market risk premium, which is the return expected from the market above the risk-free rate. The risk-free rate is then added to the product of the stock's beta and the market risk premium. Now, the result should give an investor the required return or a discount rate they can use to find the value of an asset. The goal of the CAPM formula is to evaluate whether a stock is fairly valued when its risk and the time value of money are compared to its expected return. Let us now discuss the cost of equity to not-for-profit businesses. I mentioned earlier that not-for-profit businesses raise equity capital in two basic ways. Number one is by receiving contributions and grants, and number two is by earning an excess of revenues over expenses, or their retained earnings. Now, the question is, what is the cost of using equity capital for real asset investments within not-for-profit businesses? There are 5 positions that can be taken on this question. Number 1 is fund capital has a zero cost. Since this is a not-for-profit business, contributors and stakeholders, especially the patients and insurers, does not expect monetary return on their contributions, nor they require an explicit return on the capital retained by the firm. Fund capital has a cost equal to the return foregone on short-term security investments. And since not-for-profit businesses can always invest contributions or earnings in short-term securities, low opportunity cost may be apparent. Fund capital has a cost equal to the expected growth rate of the business's assets. Now, not-for-profit businesses must earn a return on equity merely to support dollar growth in assets or the inflation. The greater the inflation rate, the greater the return that must be earned. Number four, fund capital has a cost equal to that required to maintain the business's creditworthiness. Here we all know that businesses' creditworthiness is based on its profitability. For not-for-profit businesses, to maintain the business's desired rating, managers must achieve the return on equity recommended by the rating agencies, which in turn sets the business's cost of equity target. And lastly, number five, fund capital has a cost equal to the cost of equity to similar for-profit businesses. The rationale here is on the opportunity cost concept, but it is now defined as the return available from investing fund capital in the alternative investments of similar risks. Let's go now to the corporate cost of capital. The corporate cost of capital, or CCC, is the final step in the cost of capital estimation process. It is the combination or the weighted average of the debt and equity cost estimates. Cost of capital represents the return a company needs to achieve in order to justify the cost of a capital project, such as purchasing new equipment or constructing a new building. Again, each business has a target capital structure, that is, a particular mix of debt and equity that minimizes its average cost of capital. So here's the general formula for the corporate cost of capital, or CCC, for all businesses regardless of ownership. Where WD and WE are target weights for debt and equity. RRD, or the cost of debt, RRE is the cost of equity component, and T is the marginal tax rate. Of course, a company's investment decision for new projects should always generate a return that exceeds the firm's cost of the capital used to finance the project. Otherwise, the project will not generate a return for investors. Now, to illustrate the CCC calculation for investor-owned firm like the Ortigas Hospital and Healthcare Center that will purchase an MRI, consider OHHC has a target capital structure of 60% debt and 40% equity. The company's before-tax cost of debt is 10%. Its tax rate, or T, is 30%, and its cost of equity is computed to 13.8%. Using these data, we estimate the hospital's corporate cost of capital to be 9.7%. Take note that when using this formula for not-for-profit firms or businesses, it is estimated in the same way, except that the tax rate is zero. Let's now discuss the cost of capital estimation for small businesses. We've been discussing in this chapter on the cost of capital estimation process for large healthcare business. The question is, What if the business is small, such as small clinic, solo practice, or group practice? The estimation process is the same as described, but the manner in which the component costs are estimated must be handled differently. Small businesses typically obtain most of their debt financing from commercial banks. So, a business's commercial loan officer will be able to provide some insights into the cost of future debt financing. Managers of small businesses can look to marketplace activity for guidance. That is, the interest rate currently being set on the debt issues of similar risk firms can be used as an estimate of the cost of debt. Therefore, an awareness of the current interest rate environment generally permits managers to make a reasonable estimate for their own business's cost of debt, even when the business is small. Estimating the cost of equity for small businesses is more challenging than estimating the cost of debt because such businesses do not have publicly traded stocks. Here are the three methods to estimate the cost of equity for small businesses. Number one is the debt cost plus risk premium approach. This is the easiest way among the three methods because the cost of debt is relatively easy to estimate. It is equally easy to add some risk premium, say 4 percentage points, to the business's before tax cost of debt to obtain its cost of equity estimate. However, this estimate can only be considered a starting point estimate because the risk premiums applicable to small businesses may be much larger than those estimated for large firms. The second method is the pure play approach. This is an alternative to debt cost plus risk premium approach. To illustrate, suppose the beta for a publicly traded practice management firm is 0.88. If the riskiness inherent in practice management is the same as the risk involved in the ownership of a small group practice, a beta of 0.88 can be used to proxy the ownership risk. Then, the CAPM, which we discussed earlier, approach can be used to estimate the small business's cost of equity. And finally, the build-up method. Here, the cost of equity of a similar large business is used as the base or starting point. Then, adjustments or premiums are added to account for the differences between large and small businesses. The last part of my presentation is that I will discuss the economic interpretation of the corporate cost of capital. When we try to estimate the corporate cost of a capital, it's most likely mathematical computation. But as managers, we should also examine the economic interpretation of the corporate cost of capital. The opportunity cost to the business. Now, CCC, or the corporate cost of capital, is the return that the business could earn by investing in alternative investments that they have the same risk as its own real assets. From a purely financial perspective, if a business, especially one that is investor owned, cannot earn its CCC on new capital investments, no new investments should be made and no new capital should be raised. If existing investments are not earning the CCC, they should be terminated, the assets liquidated, and the proceeds returned to investors for reinvestment elsewhere. Number 2 point. The primary purpose of estimating a business's CCC is to help make capital budgeting decisions. That is, the cost of capital will be used as the benchmark capital budgeting hurdle rate or minimum return necessary for a project to be financially attractive. The third point, investors require higher returns for riskier investments. Thus, a high-risk project must have a higher project cost of capital than a low-risk project does. And finally, the key point here is that the CCC, or the corporate cost of capital, is simply a benchmark that will be used as the basis for estimating project cost of capital. It is not a one-size-fits-all rate that can be used whenever an opportunity cost is needed in a financial analysis. And that ends my presentation of the second part of capital structure and the cost of capital. Thank you for listening and for your kind attention.